So, you want to be a trader. You have picked a market, you know what you want to buy, but you have one big question. When should you click the buy button? This is a huge deal. Getting your timing right is one of the most important skills in trading. It can be the difference between a winning trade and a losing one. If you buy too early, the price might keep dropping, and you will be in a losing position right away. If you buy too late, you might miss most of the move, and your potential profit will be much smaller. It is like trying to catch a moving bus. You need to be at the bus stop at the right time. Think about it this way. Imagine you want to buy a stock that you believe will go up. You see the price moving higher and you get excited, you jump in and buy it, but right after you buy, the price turns around and starts falling. This is frustrating, right? This happens to many new traders. They chase the price without a clear plan for when to enter. A good entry point helps you manage your risk better. When you enter at a specific planned level, you also know where to set your stop loss. This is your safety net. It protects you from big losses if the trade does not go your way. So timing is not just about making money, it is also about protecting the money you already have. Now let's be clear. Nobody can predict the market with 100% accuracy. There is no magic signal that works every single time. So the goal is not to find a perfect entry that is always right. The goal is to find a high probability entry. This is an entry point where the odds are more in your favor. It is a moment where the market is giving you clues that it is more likely to move in your desired direction. By waiting for these clues, you put yourself in a stronger position. You are no longer guessing or trading based on emotions like fear or greed. Instead, you are making a calculated decision based on what the market is showing you. This is how professional traders think. Ultimately, mastering your trade entries builds confidence. When you have a clear set of rules for when to enter a trade, you remove a lot of the stress and uncertainty. You know what you are looking for. You can sit patiently and wait for the market to come to you. You are not forced to trade. You are in control. This shift in mindset is powerful. It moves you from being a gambler to being a systematic trader. And that is a huge step forward on your trading journey. Having a solid entry strategy gives you a structured approach, which is the foundation for long-term consistency and success in the markets. So, how do you find these good entry points? You need to learn to read the market's language. One of the simplest ways is to look at the trend. The trend is the general direction the market is moving. Is it going up, down, or sideways? A famous saying in trading is the trend is your friend. This means it is usually easier to trade in the direction of the main trend. If the market is in an uptrend, with prices making higher highs and higher lows, you should look for opportunities to buy. If it is in a downtrend, with prices making lower highs and lower lows, you should look for opportunities to sell. Trading with the trend is like swimming with the current instead of against it. Another powerful concept is support and resistance. Think of these as invisible floors and ceilings for the price. Support is a price level where the market has trouble falling below. Buyers tend to step in at this level, pushing the price back up. Resistance is a price level where the market has trouble breaking above. Sellers tend to take control here, pushing the price back down. These levels are important because they show you where the buying and selling pressure might change. When the price pulls back to a level of support in an uptrend, it can be a good signal to enter a buy trade. You are buying at a discount within a rising market. You can also combine these ideas. For example, in a strong uptrend, the price will move up, then pull back a little, and then move up again. These pullbacks often happen near previous areas of support. Waiting for a pullback to a key level is a common and effective entry strategy. It stops you from buying at the very top of a move right before the price is about to dip. Instead, you wait patiently for the price to come to a more logical area. This is a much lower risk way to enter a trade because your entry point is closer to where you would place your protective stop loss, giving you a better risk to reward ratio. Finally, remember that these are just signals, not guarantees. The market can and will break through support and resistance levels. A trend can reverse at any time. That is why it is so important to use these signals as part of a complete trading plan. You need to know not only when to get in, but also when to get out if you are wrong. The best traders do not just look for one signal. They look for multiple reasons to enter a trade. Maybe the market is in an uptrend, and the price has pulled back to a support level. This combination of factors gives you a stronger reason to believe the trade might work out. Let's look at a simple example. Imagine a stock is in a clear uptrend. For the last few weeks, it has been making higher highs and higher lows. You see the price has just made a new high at $50 and then starts to pull back. Where could you enter? You look at the chart and notice that the previous high was around $45. Often, a previous resistance level can become a new support level, so you decide to wait. You watch as the price drops to $45. At this level, you see that the selling seems to stop and the price starts to stabilize. This is your signal. You can enter a buy trade around $45, expecting the uptrend to continue. Here's another example, this time using a moving average. A moving average is a line on your chart that shows the average price over a certain number of periods. It helps to smooth out the price action and show the trend more clearly. Let's say you are using a 50-period moving average. In an uptrend, the price will generally stay above this moving average. When the price moves up and then pulls back, it will often come down to touch or get close to the moving average. This can be a great area to look for a buying opportunity. You are essentially using the moving average as a dynamic area of support, a value zone where you can buy at a better price. Now let's consider a sideways market, also known as a range. In a range, the price bounces between a clear support level and a clear resistance level. It is not trending up or down. Your entry strategy here is different. You can look to buy when the price comes down to the support level at the bottom of the range, and you can look to sell when the price goes up to the resistance level at the top of the range. The key is to wait for the price to reach these extremes. Do not trade in the middle of the range as the direction is uncertain there. Wait for the market to test the boundaries of the range, as that is where the best opportunities are found. These examples are straightforward and easy for a new trader to spot on a chart. The common theme is patience. In each case, you are not chasing the price. You are identifying a key area or level in advance. Then, you are waiting for the price to come to your level. This proactive approach is what separates consistent traders from those who are always one step behind the market. You define your edge, you identify your setup, and you wait for the market to give you the signal to act. This discipline is a skill you must develop. Now you have some ideas about how to find a good trade entry, but knowing is not the same as doing. The most important thing you can do now is practice. Do not rush to trade with your real money right away. Open a demo account. A demo account lets you trade with virtual money in the live market. This is your training ground. You can test your entry strategies without any financial risk. See if you can identify trends. Practice drawing support and resistance lines. Watch how the price reacts to these levels and to moving averages. This practice is priceless. It will help you build screen time and get a feel for how markets move. As you practice, you must also be patient. This is perhaps the hardest skill for a new trader to learn. We live in a world of instant gratification, but the markets do not work that way. There will be days when you look at your charts and there are no good trading setups. On these days, the best trade is no trade at all. You must have the discipline to sit on your hands and wait. Forcing a trade when there is no clear signal is one of the fastest ways to lose money. Remember, your job as a trader is not to be in the market all the time. Your job is to wait for high probability opportunities. Another part of patience is being patient with yourself. You will make mistakes. You will have losing trades. Every single trader in the world has losing trades. This is a normal part of the business. Do not get discouraged. The key is to learn from your mistakes. When a trade does not work out, go back and look at it. Why did you enter? Did you follow your rules? Was there something you missed? This process of review and reflection is how you improve. Each trade, whether it is a winner or a loser, is a learning experience that makes you a better trader for the future. In the end, mastering your trade entries comes down to having a simple, clear plan and the discipline to follow it. Do not overcomplicate things with dozens of indicators. Start with the basics: trend, support, and resistance. Wait for the market to come to your predefined levels. Practice in a demo account until you feel confident. And above all, be patient. Be patient for the right setup, and be patient with your own learning process. Trading is a marathon, not a sprint. If you focus on making good decisions one trade at a time, you will be on the right path to long-term success.